Good morning and welcome to this Monday, January 31st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, tell you, we had a great finish on Friday. Market was very strong. And, I was expecting we'll probably see some pretty green futures this morning. And maybe a big gap up, but that looks like maybe we're going to have a little bit of a mixed picture at the open. The really beaten down stocks on the NASDAQ, many of those growth names, may see a little outperformance at the beginning of the day. Right now, we're seeing Dow futures down a little over 100 points, S&P 500 futures down just a bit. NASDAQ futures, though, are up about 40. At least as of about 5 or 10 minutes ago. So looks like maybe a mixed start to today's action after a really nice rally at the end of the week. And I'll show you some numbers here in just a bit, but 4,300 was a big level that I've been watching on the S&P 500. And we certainly went down there and tested it enough last week. It looked like we were going to blow right through it on Monday when we went down to, 4,220 or so. But we reversed, we closed back up above 4,300. Then after testing it a couple of times, we actually had a really strong finish on Friday. So it looked like maybe we have established the right side of the neckline and are at least looking like a potential bounce is in order. My guess is it's probably going to be a fairly shallow one. We'll see how it goes this week, but we are in a sweet spot historically or seasonally. As you know, or if you followed me, you would know the S&P 500 has made almost all of its gains since 1950. And this is one of the most amazing historical stats that I'm aware of. But since 1950 on the S&P 500, almost all of the gains have been made from the 26th of one calendar month to the 6th of the next calendar month. So just a little bit more than 1/3 of the month has accounted for over 90% of the gains. And that goes back over 70 years. That's a pretty interesting stat. If you think the market is just this random walk and every single day is, kind of just like every other day, I'd beg to differ just based on that stat alone. And so if you think, well, what the heck, why would that happen? Well, think about all the money, excuse me. Think about all the money that comes into the market at the beginning of the month, all the new money. And this dates back to my CPA days when I would go out and audit companies. And I just realized, one of the passions I have was doing a lot of research on the stock market. And some of that was born out of my CPA days when I'd go out to clients for audits. And I realized, hey, everybody's got payrolls that are kind of similar, and they're withholding 401k money, and it's all being sent to into Fidelities and Vanguards of the world at the same time pretty much every month. That's got to have some impact on the stock market. That's what started a lot of the analysis that I did. And so if you think about all the money going in, or a lot of the money going in the beginning of the month, you'd say, well, why would it start going up on the 26th or the 27th prior to that? Well, if you are a money manager, what would you be doing if you knew money was going to be coming in a few days? You'd probably be buying ahead of it. So I think you get this pre-money flow buying that takes place at the end of the month. Then the money comes in, you see another push higher through that first week of the month, and then you start seeing selling. Now, that is not going to happen every month. This is over a long period of time. The first time you try to, because I've had people say, well, why don't I just get in on the 26th and get out on the 6th? And I got 3 weeks or 2 weeks, 2.5 weeks, whatever, just to go out and do whatever I want to do. I'm going to still capture all the market's gains. But I can promise you, as soon as you start that, those first few months are not going to go well for you. So anyway, just keep in mind that we've got this, the money flow favoring the market right now. We've been hit pretty hard to the down. Well, been hit really hard to the downside. And so, a bounce is in order, and it happens to be at this time of the month. So you would think that if we're going to bounce, this would be it. And so just keep that in mind as we go throughout this week. All right, let's go ahead and take you over to Earnings Beats. For those of you who are new to Earnings Beats, first of all, welcome. Certainly appreciate all those who stop by every day or, frequently. But if you are new, if you go over to earningsbeats.com, you can check us out. Probably the best way to get to know us would be to go through. Sorry, I got a lot of allergies or something going on. Anyway, one of the best ways to check us out and learn more about what we do is to subscribe to our free Earnings Beats Digest newsletter. There's a lot of reasons to subscribe, but one is just to get our 3 times a week publication. It's usually just a couple paragraphs and a chart, so it's very quick, very easy, and it's more educational, I think, than anything. We're just trying to pass along a lot of things that we've learned over the years. And so I think you'll find it very educational. I think you also may find trading candidates in there from time to time if you so choose. Of course, any of the risk is yours, but we're just trying to provide some ideas and some education for those out there who want to learn more about technical analysis. But another reason to sign up for this would be we have free events coming up from time to time, quite a few of them, honestly, and we will send out room instructions to everyone that's on this list. So everyone that's in our community, we make sure that you get instructions to come into these free events. So it's a great way for us to give back. And at the same time, great way for you all to learn a little bit more about us, how we approach the market. It may be different from the way you approach it, which is fine. You might pick up a couple of things here or there that you like, maybe you would incorporate in what you do. But there's always 2 sides of the market. That's what I always say. I mean, I may be very bullish something, you may be very bearish something, and you may be 100% correct. Everybody's going to be wrong from time to time. If you do this enough, there's no such thing as mastering everything and being right all the time. That just never happens. And the market's constantly changing. So even if you do get something right, you feel really confident, be ready, because probably the carpet's going to be pulled out from under you. Anyhow, those right there, that's the area where you can sign up. This is completely free, by the way, no credit card required. You can unsubscribe at any time, no questions asked. But I think it's a great way to learn a little bit more about the market and to learn about us at Earnings Beats. All right, let's move on to the market recap from Friday. Like I said, big rally in the last 30 minutes on Friday. And, I was talking to John Hopkins on Friday afternoon, and we were kind of just exchanging some messages back and forth. And I thought, we kept going up and looked to me like we were trying to break out above a trend line. And I'll show you this trend line in just a minute, but it's we'd been in this downtrend for a while on the S&P 500. And when we went through, I don't know what it was, probably at about 4370 or 4375, right about when we went through there, that's when it seemed like everybody was jumping on board in those last 20 or 30 minutes and sent the S&P 500 up another 1.5% or something into the close. But anyway, it was a nice recovery. You can see the Dow Jones Industrial Average threatening to move down below this 34,000 level, but it did hold. The S&P 500, there's that 4,300 level I talked about. Went down on Monday. It was pretty scary. I don't know if that was 4210, 4220, but we came all the way back, closed above 4,300, and we tested it again throughout the balance of the week, maybe 2 or 3 more times, but held every time at 4,300. And that's a big level on the chart. I think now we're into what appears to be a right shoulder. So I'll show you that chart in just a minute. The NASDAQ getting hit much harder than the others on a relative basis. So percentage losses were higher. But of course, the NASDAQ did better when growth was in favor. Growth's not in favor. And so NASDAQ is struggling, as you would expect. But it has lost the levels that it saw from back in that October low. So definitely a little bit more technical damage being done and inflicted on the NASDAQ so far. Mid caps, small caps also both broke down below these prior lows. And growth was not in favor at all last week. I mean, even though we got the rebound and we saw all of these key support levels, like on the S&P and the Dow hold, the value stocks, for the most part, outperformed growth stocks again last week, even with the recovery, especially in the small cap and the mid cap arena. Large caps, I think large cap growth did outperform value, mostly because of Apple. Apple had a big day on Friday after a really solid earnings report on Thursday. It's going to be very interesting to see. I think Apple might be the poster child for the market going forward here, because it is the largest holding, and they had a great report. The market seemed to love it. If Apple can't go back or doesn't hold that low that it established back in the 150s last week before its earnings came out, that would be a really bad sign for the overall market. So, if you want the S&P 500 to stay out of cyclical bear market territory, I think you're pinning your hopes right now on Apple, because Apple is a big piece. And if Apple can continue to perform well, that might help the S&P stay out of bear market territory. But otherwise, I think you really want to be careful with the overall market. All right. Sectors, looking at the sectors, you got technology was the big leader, of course, with that rally on Friday afternoon, and with Apple's numbers, technology gained 4.3% on Friday. That was a big day. Hadn't seen a day like that out of technology in a while. Real estate also did well. Communication services doing well. Discretionary healthcare, all of these groups up at least 2%. So really nice, broad advance to the upside. Energy, which has been the best performing group. I don't show it on here, but energy, which had been, just on fire, actually took the day off on Friday. We saw energy fall fractionally. All right, let's keep moving. The 10-year Treasury yield. So this morning we've got, let's see here. Sorry, just checking something else out. All right, so later this morning, we're going to get the January Chicago PMI. That is expected to come in at 62.1. December was 63.1. So we're looking for a little drop there. The 10-year Treasury yield, which is, I think, like in a bull flag pattern, move up. Got this little, maybe slightly lower highs, slightly higher lows. It's almost like a little pennant flag off of this uptrend. So it does appear to me like this pattern is more likely to resolve to the upside. And of course, if we do that, then I think we've got some more issues with growth stocks going forward, because anytime rates are on the rise, whether it's warranted or not, whether or not you believe rates are going up long-term or not, the perception sometimes can be just as bad, if not worse, than the reality. So the market will price things in long before you ever, see the peak in interest rates, the peak in, or the drop in growth stocks is going to be ahead of that, that peak in interest rates. So anyway, I see rates going higher. I think we're probably going to challenge 1.95, 2%. Probably sooner rather than later, and then we'll see whether or not we break above that level. I do think if we get through that 2% area, we could go all the way up to 3%. If we do that, we're going to probably move into cyclical bear market territory for sure. I just can't see the big growth stocks weathering that kind of a move up in interest rates, even though they are pricing in a lot of bad stuff right now. I don't know if they're pricing in a 3% 10-year Treasury yield. So anyway, we'll keep watching this every day. We'll see what happens, kind of watch the growth stocks on a relative basis like we've been doing, and continue to report it. All right, moving on to the S&P 500. So before I get into this pattern, let me show you on the 10-minute 5-day chart. We're going to go back further, though. Let's go back about, 20 days. And you can see this trend line that I was talking about. I'll go ahead and annotate this for you if you can't see it. But if you just take those, see how if I connect all of these highs, for the most part, they all just about connect perfectly right there. So this high, these highs, these two highs, these two highs, and then see what happened on Friday at the close. We kind of got that melt up. I mean, we've still got some overhead resistance here. So we're going to have to get through 4450 there. Then we got up near 4500 right here. And then, of course, when we get into the daily chart, we'll talk about 4500, 4550 a little bit more. So let's move away from that. Let's go back to that daily chart. And what I was looking for, calling for, if you will, was a neckline to form right there at 4300. So we had this move up, big move back down in September. That set a pretty important low. And then when we moved back up into November and especially December, remember all the warning signs in November? The S&P was going up and the volatility index was going up. I wrote about that sometime in mid-November. So that was a warning sign. Then, of course, we had options expire, but that's short term. Options that can be resolved in just a few days to a week or so. That's not anything that I worry about longer term. And the same goes with the VIX. That's more of a short-term warning. Market, if we get some bad news, market probably pull back. And so we got that move to the downside. That was the short-term warning. This was the short-term selling. When we moved back up in December, the problem was that all the defensive groups were leading the move. When I published an article, or maybe it was in the weekly portfolio report, I don't remember where I wrote it. But when we moved up here in December and set this new high, at the end of December, I copied and posted a 1 month return for all the sectors. And at the end of December, by far, the 4 best groups were the 4 defensive sectors. And all of the other groups were up, but they were up less. So you could see the money rotating into defensive groups. And that's when I started writing some pretty bearish articles at the end of the year saying, I thought 2022 could get off to a rough start. I wrote, an article about Apple. If Apple comes down, growth stocks get hit, Apple drops, that could take the whole market down with it. All of that was written back at the end of December. Then we actually started seeing the confirmation of those warning signs. It's like, when you see a really bad storm in the distance and you're thinking, wow, that looks bad. We could really get hit with something. Well, that's a little different than the storm being over, you knocking down trees. And that's what I was seeing back at the end of December, just those storm clouds. Doesn't mean that we were going to hit with the storm. It's just that if, you have to see that because it provides you kind of an advanced warning of, hey, things could get really bad. And you can do whatever that means, for each individual. You could go to cash. You could maybe, buy some insurance, through some puts. I mean, there's lots of different ways that you can protect, and everybody's different. Somebody who's in their retirement, who's been riding the market to the upside, maybe a little nervous and that, hey, I don't want to be part of the potential of a big pullback. I'm going to cash. Completely fine. Others might want to hold their positions for tax reasons. Maybe you sell calls against those positions to just limit some of the downside. There's a lot of different ways, a lot of things, and it's different for everyone. And, one thing I always say at Earnings Beats, we are not registered investment advisors. I don't know what everyone's position is in the market and what your financial goals are and where you stand. Everybody's different. Some probably have no business getting into the riskier stocks. Others love to get into the riskier stocks. And so there's all this, all these different financial situations that are out there. So it's really irresponsible for me or anyone to come across and say, hey, this is what everyone should be doing. It doesn't work that way. All I want to do is pass along what I'm seeing in the market, and then everybody can do their thing, whatever that means. Anyway, now we're in the middle of it. So now the storm's here, and we've seen the S&P 500 move from over 4,800 down to 42 and change in the course of 3 weeks. 3 or 4 weeks. It's pretty crazy when you think about it. The amount, the market value that's lost. And I know there's some of you saying, well, look at all the market value that was gained over after the pandemic. That was crazy too. And it was. I mean, we went up, we stayed up there for a while. I've shown you the 10-year or 15-year S&P 500 chart where I've got the channel, and we actually moved out of the channel to the upside. Those are all things that are very real. And yeah, we probably got a little bit ahead of ourselves. So we probably needed this pullback to begin with. There's always a reason why you can pull back. So it's kind of crazy when the market finally decides that, hey, now's the time. But anyway, there were a lot of those warning signs out there, and now we're in the midst of it. So where do we go from here? Well, there's your neckline support, 4,300. If you are following the S&P 500, you don't want to close below 4,300, in my opinion. Sure, you could have a false breakdown. I mean, we've seen those before. We had one of those on Monday of last week, had a big move down to 42 and change, but we came back up, held it on the close. That was a really good kick save right there. But if we lose it, you can't stay in the market saying, oh, well, I hope it's a kick save, because then it goes down a little bit further, then it goes down a little bit further. And then all of a sudden you're like, well, shoot, I'm almost to the measurement. I might as well just stay. You just keep making excuses for why you should be in the market. And then you blame the market. Well, it was the market's fault. I always enjoy listening to Dave Keller talk about biases, and how when you're doing everything great, it's because you're really smart. But when things go against you, it has nothing to do with your skill. It's all about the market and how unlucky you are that the market's, being bad. It all comes down to us. Always does. Always will. We make our choices every day. So I would be very careful if 4,300 is lost. Now, in the short term, now that we've held this, I think the 20-day moving average would seem to be a magnet. Normally in a downtrend, that's where you would be looking. That 20-day would come in at 45.31. So it's about, well, it's almost exactly 100 points higher than where we closed on Friday. So we've got that overhead that we're looking at. You also can see this short-term breakdown below 4,500. So a move maybe up to 4,500. But that's the area. And, normally, not everything's going to work out perfectly, but the perfect bearish pattern for me here would be a right shoulder that stays below the left shoulder. So the left shoulder, I don't know, we got up to what, 45.40, 45.50, something like that. So you go up to the 20-day 45.31, that would be a right shoulder that's slightly lower than this left shoulder. And the reason I say that it's almost like you want to see the head and shoulder kind of leaning over a little bit. We already saw the left side of the neckline intraday go below this. So that's a lot of stops being cleared. Anybody who's looking at this chart probably had stops in here, probably got stopped out. And then the market reverses it, of course, just to start working with everybody's minds. Because this is the hardest thing when the market is this volatile. It's the constant feel like you're always chasing everything, to the downside. You're in the market. Now you're losing money and you're like, all right, I'm just going to get out, and you sell. And about that time, it's back up again. Then you're like, oh, I sold too early. I'm going to jump back in. And about that time you top. And this is how the market makers make a ton of money with high volatility and wide swings in very short periods of time. I personally like to just sit it out. I know I'm missing out, if you will, on some chances, at some big moves, but I'm also missing out on the bad stuff, the emotional stuff, where the market has a way, when you start losing a lot of money in a short period of time, the market has a way of convincing you that whatever you were thinking about before isn't right. Now it's got a mirage and you're looking at this mirage. You don't know what to do. I don't like getting into that situation. So I prefer just to sit it out. If I was going to short this market, I would short it closer to that 4,500 level, maybe up to the 20-day. And then pick your spot where you want to get the heck out. Maybe it's 4,600. Maybe it's the 50-day moving average, whatever it is. But I think you got to put have your lines in the sand and stick with it. Hey, this market could bounce right here and go straight back up to all-time highs. I would not be shocked. I don't think that's going to happen based on everything I'm seeing right now. But we are in a secular bull market, and shorting a secular bull market isn't easy either. There's nothing easy about the stock market, especially when it gets volatile. So I would just be picking out my spots. 4,300 was my spot to the downside. So far, we're holding it. To the upside, I'm going to say the 20-day EMA. 4,500 and that 20-day EMA, that combination right there is where I would be looking for failure. So we might get an intraday move just to kind of throw everybody for a loop. We might have a day where we're up 100 points on the S&P and it's up to 4,600. And then the close, we come back down and close below that 20-day. That would probably be very similar to this false breakdown. That would probably be the time to get in on the short side if we see a day like that. All right, spent a lot of time on the S&P, but I do think this pattern is interesting. And I think it's going to be very, very meaningful if it breaks down. So we'll want to keep an eye on that. The other point I'll make is that there is this thing called the January effect. And on Wall Street, the saying goes, as January goes, so goes the year. And typically when we see big down years in January, normally the rest of the year is not good. Now, obviously, you could say, well, when you have a bad January, you're going to have a bad year because you had such a bad January. But I'm actually talking about the balance of the year. Forget about what just happened in January. From January 31st close through the balance of the year, that is normally worse when you have a bad January. Not every time. Nothing is ever, don't ever think they're guarantees in the market. But if we're talking odds and probabilities, that's the whole thing with the January effect, is that if you have a really strong January, the rest of the year tends to be very strong. If you have a very weak January, the rest of the year tends to be very weak. So I don't know that I would be looking for a 25% recovery the rest of the year. Those normally only happen when you have good Januaries. So I think the end of the year is going to be somewhere, about where we started it, maybe even a little lower. That's if I'm correct about it being a cyclical bear and we go back into the 3000s, which I think is still the highest probability. Not a guarantee, but I think that's the highest probability, I would say. Because I do think inflation is going to remain a problem. I think the interest rates, it's going to be a lot of talk about the Fed, money rotating away from growth. And so I think we'll have a very, very solid bottom to trade off of, maybe later in the first quarter or into the second quarter. But I think it's going to be a little while. I think we've got to deal with this first. All right. One area of the market, by the way, that was kind of shrugging off a lot of the selling for a while was semiconductors. Yeah, we went up. We just kind of went sideways. End of December, we were up here near an all-time high. Even into mid-January, we had been holding on to this 87.50 level, got back to 92.50. That was just 10 days ago. And these last 2 weeks, semiconductors have been absolutely crushed. And, I've had some emails coming in from members talking about, well, what's wrong with semiconductors? Why are they going down so much? Well, semiconductors are growth stocks. I mean, they are high octane growth stocks. When the market's when they are in favor, they tend to go up very, very fast. And when they're not in favor, they tend to go down very, very fast. And to make your head spin, because you're looking at the prior fundamentals, which still are very strong, earnings growth, everything. And you're looking at the current activity and they don't line up. Well, a lot of times it's because the future numbers that you see are not going to be as strong as the prior. So we'll see how semiconductors play out. But again, I would watch that 20-day EMA. I think if you get a bounce, maybe you get back up to that 82, 8,300 area. And then I would be looking for another drop in the semiconductors, unless the overall market just gets healthy again. And again, that's possible. I'm going to be looking for signs. I mean, we don't want to be going up with defensive stocks leading again. We want to see the growth stocks come back and lead the value stocks, which we really didn't see last week. So there's still a lot of things that we can be checking out. And that's what we will be doing. All right. Let's move on. I wanted to show you some stocks that are going down, but look interesting with the AD lines. So here's one, Edwards Life Sciences. So you can see the stock breaking to multi-month lows, but its AD line is held on to these lows. We're sitting kind of just going sideways. So, you can look at this and say, well, I don't care. Doesn't matter to me. I look at price action. We broke down. Hey, if that's your view, that's fine. I find it interesting, though, when the AD lines, if you just know the formula for the AD line, how it's calculated, it's based on where you close relative to your high and low that day. So for instance, on Friday, you can see EW came all the way back up to 105, closed at its high. And so that becomes the multiplier. If you close on the high, then it's 100% times the volume gets added to this AD line. The AD line, notice there's no numbers over here to the right. It's just this cumulative since the beginning of time kind of thing. And so volume in this case was added. You can see the AD line going up on Friday. And if you go back to this day, which was January 24th, you see this hammer. We actually finished down for the day, but we finished at the high of the day. So for the AD line, it actually went up. If you looked at the OBV, the on balance volume, it only cares about whether you went up or down. So in this case, on the 24th, because we went down, all of this volume would have gone down on the OBV, but on the AD line, it goes up. Which one do you favor? Are you more of an OBV person or are you in an AD line? I like the AD line because I think the market's heavily manipulated. I like to see who's buying at the end of the day. Early part of the day, it's like amateur hour. You're breaking down, folks are get their stops in. You don't know until the end of the day whether or not you hold support levels. And that to me is really important. So I prefer the AD line because it's going to take into account that end of the day. OBV is not. You could have a great rally into the close, but if you finish down, you could be, EW was trading at 113 or whatever. opens this day at 110, goes down to 105, comes all the way back to 111. I mean, that's a big reversal. OBV treats it, all that volume, all of it, as negative, just subtracts it. I like the AD line because it does factor in whether you close strong or whether you close weak or whether you're just in the middle. If you're right in the middle, there's no change. The AD line won't budge if you close in the middle of that day. So anyway, when I look at it and I see the AD line kind of hanging in there, even though price is going down, it just kind of tells me that, there's some buying in there that's keeping the AD line up, and it's afternoon buying. And that was a massive clue for us back in the pandemic. That was probably one of the best market calls I've made in my life, was seeing the difference in the way stocks were trading back in March and April of 2020. They were all going down at the open when the futures were down, but some were coming back during the day and others weren't. And the AD line was the indicator that told us. So I guess, I'm not sure how important this indicator is every day, just looking at the market, but I think there are periods of time when the market's being manipulated. I think it's important. I thought the panic in March was one reason. And now that we're getting into this next wave down, this is probably the worst selling we've seen since the pandemic, the February, March selling. And I'm wondering if we're going to see a repeat on some of these stocks. So that's why I'm pointing these out. Anyway, this is one. Let's take a look at some others here. MXL, this is a small semiconductor company. But look at this. Look at the selling. This stock was at 77. Now it's 55. Market just opened. So I'll try to wrap this up in a second. But look at the AD line, still up near the high. So this is an interesting one. How about Tandem, TNDM? Tandem staying up, even though prices have dropped to about a 5-month low. AD line remains up there. How about Verisk? Analytics, VRSK, big move down. Seeing a little bit of movement in the AD line, but not nearly as much as the price would indicate. And this might be one of my favorite ones, Airbnb. We have now moved all the way back down to almost the 130 level to test 52-week low. And the AD line just keeps going higher and higher. So is this stock really being sold, or is it being manipulated, and are we seeing gap downs followed by accumulation? AB&B looks like an interesting one. All right. Anyway, let's move on to the three you must see. I'm going to wrap this up. Let me go over one earnings report. L3 Harris Technologies, LHX. This is in the defense group. You can see gap down with their earnings today. So down almost 4%, down $8. I'd watch this recent low down here close to 200. If we do see selling and move back down there, that would be interesting. The other thing is the AD line hasn't really been that bad. So maybe if we see morning weakness, that might be an opportunity, because if the AD line, you can see we're starting to roll over and go lower, but that AD line seems to be wanting to go higher. So it could be that morning weakness is an opportunity on a stock like this. So that'll be something interesting to watch too. If we're down in the morning, does LHX rally back? Because there is going to be big volume today with earnings coming out. All right, the last three I'll give you real quick here on the three you must see. I just wanted to point out three stocks. While we're all focused on these growth stocks, the market getting hit, there are areas of the market that are doing much, much better. MasterCard, let's get an update here. MasterCard is, on Friday, closed at the highest level it had seen since back in early August. So we are definitely seeing more positive action in MasterCard. AXP, American Express, same thing. Maybe not 5 or 6 months, but January has not been that bad. We've actually gone up about $10 this month on AXP. And then the last one, Vertex Pharmaceuticals. This is how I think it's going to end for a lot of growth stocks, where it just seems like we're never going to, find any buyers again. And then all of a sudden it's just going to take off and you're going to be afraid to buy because market's gone too fast. And Vertex, after, downtrending, look at that volume move right here. That's a Marubozu candle, or very close to a Marubozu candle, where you actually open near the low and you close near the high, the big hollow candle with heavy volume. Those tend to be very bullish candles, especially after a downtrend, to mark the end of a downtrend. This is a breakaway gap. And you can see we just keep moving higher and higher on Vertex. All right, so those were the stocks I wanted to show you for the three you must see. Let's get a quick update on the market, and then we'll wrap this up. So still got that bifurcation going on. Dow minus 130. You got the S&P down 3, NASDAQ up 57, VIX up a little bit. It's still elevated, even though it's come down a lot from that recent high. We saw at 39 down to 28. It could shoot back up into the 30s at any point. I'd like to see the VIX maybe move back down to the lower 20s and see the S&P get back up to that 4,500 area or maybe even just above. And at that point, if you're into shorting, I think that would probably make the most sense from a reward to risk standpoint. Again, not providing any guarantees. It's just going to minimize your risk in the event that you're wrong. You'll be able to set stops where they don't get too far away from you. I know a lot of folks wanted to short last week when the market's down at 4,300. The problem is, now we have the big move to the upside and you're still not anywhere near a major resistance level. So those shorts become pretty big losers rather quickly. All right, that is it for me. Appreciate everybody tuning in. Be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That'll start at 9 a.m. Eastern. So at 9 a.m., just go over here, click on Stock Charts TV, and you should see the next episode of Trading Places Live coming up. Of course, your next episode here at Earnings Beats will be on Wednesday morning at 9 a.m. Everybody have a great day and happy trading.